Hello, this is Sophie Hammond and your Patton University online course instructor for this semester. We are in course FIN610, Risk Analysis and Insurance, and today we will be briefly going over Unit 7, Life Insurance and Entitlements, beginning with the introduction. What would happen to your family if you did not make it home from work today? Could they still live in the same house and maintain the same lifestyle? Are they protected financially in case of your absence? This is the basic premise of life insurance. Premature death, commonly defined as dying before the expected retirement age, is an uncertainty for all of us. The value of human life for private and business purposes can be estimated by the value of the income stream that the deceased person would have had and the estimated financial needs of the surviving heirs by use of an instrument called a needs analysis. This financial planning process creates a cash flow that is translated to present values. Life insurance operates much like previous insurance models we have discussed, in that it is a pooling of exposures into a group. Premium rates are set based upon the probability of death. The basic types of life insurance are term life, whole life, universal life, variable life, and variable universal life. Looking at these comparatively, term life provides protection for a specific period of time and enjoys predominantly fixed premium rates, but has no cash value other than the payout if the insured dies. Whole life insurance provides lifetime protection with fixed premiums and a cash value that is guaranteed with similar death benefits. Three traditional types of whole life insurance include ordinary or straight life, limited payment life, and single premium life. Finally, the distinguishing factor for universal life is a clear separation of mortality, investment, and expense components. Group life insurance plans are commonly offered to employees and typically provide death benefit amounts equal to a percentage of the employee's salary. We will start the unit, however, by looking at the two social insurance programs, Social Security and Medicare. Social Security and Medicare are two compulsory programs funded in the United States by employment payroll taxes paid by employers and employees. The amount of benefits received is dependent upon the primary insurance amount, which is based upon an individual's average indexed monthly earnings. The most highly discussed topic related to Social Security is the prediction that the OASDI and high trust funds are only expected to be adequately financed for about 10 more years. The anticipated trend is privatization of social insurance plans, especially for retirement benefits. Understanding the fundamentals of life insurance will provide a tool for reducing the personal risk associated with premature death. There are three learning objectives. The first is to analyze the effectiveness of Social Security and Medicare. The second is to predict future trends in Social Security and Medicare. And the last is to compare various individual and group life insurance structures. We will be beginning in Objective 1, analyze the effectiveness of Social Security and Medicare. Starting with the first reading, definition, eligibility, benefits, and financing of Social Security. Definition of social insurance. Many governmental programs are designed to provide economic security for individuals and families. Both public assistance, also referred to as welfare programs, and social insurance programs are organized and undertaken by the government and have the broad social purpose of reducing want and destitution. However, social insurance is different from public assistance. Social insurance is an insurance program that is compulsory for nearly all Americans. Eligibility criteria and benefits are specified by law, and financing is wholly or partially covered by the employer. Unlike public assistance, employers and employees pay into the social insurance system to earn their rights to benefits. Some examples of social insurance programs include workers' compensation and unemployment compensation, which were covered in Chapter 16, Risk Related to Job, Workers' Compensation, and Unemployment Compensation, as well as Social Security. Welfare benefits are financed throughout general revenues that come from both federal and state funds. Benefits received from welfare are not based on contributions made by or on behalf of the recipients. Medicaid is an example of a welfare benefit based solely on need. While public assistance programs have a role in providing economic security, they are not insurance programs. The insurance principles of assessing and pooling risk do not apply to welfare programs. Types of benefits available from Social Security are apparent from the acronym OASDHI, Old Age or Retirement, Survivors, Disability, and Health or Medicare benefits, which include hospital insurance and supplemental medical insurance. The program can be separated into two broad parts. The first part of OASDHI is the Old Age Survivors and Disability OASD insurance program known as Social Security. The second part of the OASDHI program is Medicare, HI. We will begin the discussion about Social Security and Medicare with a description of each social program, its benefits, and its eligibility requirements. Following the general discussion is an explanation of how the programs are financed. We will introduce the two programs separately because there are many differences between Social Security and Medicare. We begin with the eligibility requirements and then discuss the benefits available to eligible employees. Coverage and eligibility requirements. Today, nearly all employees in private industry, most self-employed persons, and members of the armed forces are covered by Social Security. Coverage is compulsory for more than 90% of all workers in the United States, meaning that Social Security taxes must be paid on their wages. The major exceptions are railroad workers, who are covered by the Railroad Retirement Act, and federal government employees who were covered by other programs before 1984. Prior to 1984, state and local government bodies could elect not to cover certain employees under Social Security. With few exceptions, this option is no longer allowed. Municipal governments that elected out prior to 1984 do not have the option to join the Social Security program voluntarily. Ministers are covered automatically unless they request a waiver on religious grounds. Members of religious sects whose beliefs prohibit acceptance of benefits are exempt. Eligibility. To be eligible and receive benefits, a worker must achieve insured status. There are three levels of insured status: fully insured, currently insured, or disability insured. If the worker's status is fully insured, most types of Social Security benefits are payable. If the worker does not have enough work tenure to be fully insured, he or she may be currently insured or disability insured, which still allows eligibility for some survivors' benefits or disability benefits. A person must be in the workforce for a minimum number of quarters during which his or her earnings meet minimum criteria. The earnings required per quarter in 2008 was a minimum of $1,050, and in 2009 that amount increased to $1,090. The amount is adjusted every year. An employee can earn a maximum of 4 credits per year, even if he or she did not work the full 4 quarters, as long as he or she made enough in 1 month, 4 times $1,050. A Social Security beneficiary is fully insured once 40 credits of coverage are earned, or when the beneficiary has a minimum of 6 credits of coverage and, if greater, at least as many quarters of coverage as there are years elapsing after 1950, or after age 21 if later. For example, a person age 25 who has 6 credits of coverage is fully insured, whereas a person age 40 needs 19 credits to be fully insured. Currently insured status is achieved if the Social Security beneficiary has at least 6 credits in the 13-quarter period ending with the quarter of death. Disability insured status is gained by the Social Security beneficiary having 20 credits in the 10 years before disability begins. Less rigorous disability requirements apply to a beneficiary who is under age 31 or blind. Types of benefits. As noted, Social Security pays 4 types of benefits: old age, survivors, disability, and Medicare. Following is a more detailed description of each of these benefits. Retirement old age benefits. A fully insured worker is eligible to receive benefits, including retirement income benefits. A spouse or divorced spouse of a retired worker is entitled to a monthly benefit if he or she is 1, at least age 62, or 2, caring for at least one child of the retired worker, under age 16 or disabled if disability began before age 22. A dependent child, grandchild, or great-grandchild of a retired worker who is 1. Under 18, or 2. A full-time student between the ages of 18 and 19, or 3. Disabled if disability began before age 22 is also entitled to a benefit. Table 18.2 summarizes these benefits. Normal retirement age. Normal retirement age for the purposes of Social Security ranges from 65 to 67. A fully insured worker is entitled to receive full retirement benefits at the normal retirement age for Social Security or reduced benefits as early as age 62. A schedule of the new retirement ages is shown in Table 18.3, Schedule of Normal Social Security Retirement Ages. Early retirement. Early retirement benefits are permanently reduced in amount because the expected benefit payment period is longer than it would have been starting from normal retirement age. In the case of early retirement, a benefit is reduced 0.05% for each month before the normal retirement age for Social Security benefits. The earliest a person can retire with benefits is age 62. Beyond 36 months, the benefit is reduced 0.05% per month. For example, assume that the normal retirement age is exactly age 67 and that a person decides to retire at exactly age 62. There are a total of 60 months of reduction to the worker's expected benefit. The reduction for the first 36 months is 0.05% times 36, or 20%. The reduction for the remaining 24 months is 0.05% times 24, or 10%. Thus, in this example, the total benefit reduction is 30%. Late retirement. Likewise, postponing retirement past Social Security's normal retirement age, late requirement, results in a permanently increased benefit amount to compensate for the shortened length of the payout period and to encourage older workers to continue working full-time. No delayed retirement credit is granted for retiring past age 69. Survivors' benefits. Social Security survivors' benefits protect the surviving dependents of a fully or currently insured deceased worker. The surviving spouse is entitled to monthly income payments if caring for a child who is under age 16 or a child who is disabled by a disability that began before age 22. A child of a fully or currently insured deceased worker is entitled to benefits if he or she is 1. Under 18, is disabled by a disability that began before age 22, or is either 18 or 19 and a full-time student attending an elementary or secondary school, or 2. was dependent on the deceased worker, or 3. is not married. Table 18.4, Who gets monthly benefits if a fully insured worker dies, summarizes who gets monthly benefits if a fully insured or currently insured worker dies. A widow or widower of a fully insured deceased worker is qualified for benefits at age 50 if disabled, and otherwise at age 60. A divorced spouse also qualifies if he or she was married to the worker for at least 10 years and has not remarried. A parent of a fully insured deceased worker is entitled to benefits if he or she 1. is at least age 62, 2. was receiving at least half of his or her support from the child, 3. has not remarried since the child's death, and 4. is not entitled to a retirement or disability benefit equal to or larger than the survivor's benefit. In addition to these monthly benefits, a small lump sum death benefit of $255 is paid upon the death of a worker who is fully or currently insured. It is paid to the spouse living with the worker at the time of death, or a spouse otherwise entitled, or children entitled as described above. In the absence of a spouse or children, the death benefit is not paid. It is the only benefit that has not increased since the Social Security legislation was passed in 1935. The reading goes on briefly to talk about disability benefits, but we are now going to move into Objective 2, which is to predict future trends in Social Security and Medicare, starting with the only reading, Issues and Global Trends in Social Security. Issues in Social Security. During the 2000 presidential election campaign, Social Security financing was the most heated issue, with the debate focusing on privatization and moving away from the pay-as-you-go system. When the stock market was booming, and everyone believed they could do better by investing their own funds, the idea of moving away from the current system became very appealing. However, their tune changed after the large decline in the stock market. The immediate big issue in early 2006 was how to help those who could not pay the deductibles and coinsurance for the new drug program. The major funding problems are still at issue. Social Security and Medicare were originally designed to operate with advance funding, but for many years they have operated on an unfunded pay-as-you-go basis. As a result, this generation of workers is paying for benefits of current beneficiaries. Social Security taxes have increased much faster than the general level of prices and even faster than the cost of healthcare during the past 2 decades. As described in the box, does privatization provide a more equitable solution, and depicted in figure 18.2, the number of retired workers has increased faster than the number of those working. In 1945, there were 42 workers per retiree. Currently, this has decreased to approximately 3 workers per retiree and is expected to decline to 2 by 2020. The Social Security funding burden is being borne by a shrinking sector of society because birth rates have declined and longevity has increased. This trend will continue as the baby boomers move out of the workforce and into retirement. Retired workers are concerned about the certainty of their benefits and future required tax rates. The current generation of taxpayers has serious doubts in the ability of the Social Security system to deliver benefits at current inflation-adjusted levels. Such doubts are understandable, considering recent problems of the OASI program, which is by far the largest part of the system. Each year, the trustees of the Social Security and Medicare trust funds report on the fund's status and their projected condition over the next 75 years. The 2008 annual reports continue to show that both Social Security and Medicare need serious reform. Both programs face a long-term financing gap. Closing the gap between monies is going to the Social Security and Medicare funds, and monies coming out of the funds will be a challenge. It will force the government to come up with innovative solutions to fixing the long-term deficits. As figure 18.3 shows, the OASDI and HI trust funds are expected to be adequately financed for only the next 10 years, depending on the actuarial assumptions. Figure 18.4 shows the deficits of the Medicare Parts B and D trust funds, and the deficits are expected to grow rapidly. Whether the objective of the Social Security program should be to provide a floor of protection or a reasonable level of living remains debatable. Reform will require agreement, however, by politicians and the public on not only what benefits citizens are entitled to, but what benefit taxpayers are willing to fund. See the box, The Future of Social Security, for a discussion of this topic. Global trends in Social Security systems. In many countries, financing the government's Social Security system has become increasingly difficult for several reasons. Benefit levels have increased in many nations to the point where the tax rates necessary to support benefits are at an all-time high. For example, free or very low-cost medical care may be available to everyone. Disability benefits may require little proof of inability to work, and generous disability payments may result in the moral hazard of malingering. Demographic trends in other industrialized nations mirror those in the United States. The population is aging, so fewer workers finance the pay-as-you-go system for retirees. The declining birth rate suggests that this trend is unlikely to be reversed. In addition, other governments also face the problem of growing budget deficits. Governments in some developing countries may be perceived as unable to administer the Social Security system fairly and efficiently. Experts anticipate a shift from public sector social insurance plans to private sector plans, especially for retirement benefits. Private sector organizations, particularly insurance companies, have successfully managed retirement savings and income for decades and are in a position to improve management and funding practices. Several countries have already begun to privatize the Social Security system, namely Chile, Peru, Mexico, Italy, and Japan. In Chile and Peru, for example, workers are required to contribute to their own retirement fund, and contributions are invested by a private pension fund manager selected by the worker. In both these countries, the pre-funded privatization system appears to be working well. Some countries are also moving towards privatized medical care systems. This trend towards privatization is worldwide, including both industrialized and developing countries. The potential for market expansion for insurers and other financial institutions is tremendous. There are some boxes to read and the key takeaways and discussion questions, but we will now be moving into Objective 3, which is to compare various individual and group life insurance structures. Beginning with the first reading, life insurance market conditions and life insurance products. Market conditions. The life insurance industry is one of the largest industries in the world. Premiums for life, health, and annuity grew by 5.7% from $583.6 billion in 2006 to $616.7 billion in 2007 in the United States. This section concentrates on the life products sold to individuals. A comprehensive summary of these products is available in Table 19.3, Characteristics of Major Types of Life Insurance Policies. The trend is toward lower life insurance rates for all types of insurance products. Improvements in mortality rates have accounted for lower expected rates. This improvement was also highlighted in Chapter 17, Life Cycle Financial Risks. The life/health industry's condition deteriorated during the economic recession beginning in December 2007. These problems are detailed in the box, The Life/Health Industry in the Economic Recession of 2008 through 2009. Term insurance. Term life insurance provides protection for a specified period called the policy's term or duration. When a company issues a 1-year term life policy, it promises to pay the face amount of the policy in the event of death during that year. Duration. The length of term policies varies. Common terms are 1, 5, 10, 15, and 20 years. Term policies are often not renewable beyond age 65 or 70 because of adverse selection that increases with age. Increasingly, however, yearly renewable term policies are renewable to age 95 or 100, although it would be unusual for a policy to stay in effect at advanced ages because of the amount of the premium. Yearly renewable term policies are subject to high lapse rates, that is, failure to be renewed, and low profitability for the insurer. Short-term life insurance policies involve no investment element. Long-term contracts, for example, term to age 65, when accompanied by a level premium, can accumulate a small cash value element in the early years, but this is depleted during the latter part of the term because then the cost of mortality exceeds the sum of the level premium and the investment earnings. Two options are typically available with term insurance sold directly to individuals: renewability and convertibility. Renewability. If the policyholder wishes to continue the protection for more than one term, the insurer will require a new application and new evidence of insurability. The risk of being turned down may be handled by purchasing renewable term insurance. The renewability option gives the policyholder the right to renew the life insurance policy for a specified number of additional periods of protection at a predetermined schedule of premium rates without new evidence of insurability. Renewability protects insurability for the period specified. After that period has elapsed, the insured must again submit a new application and prove insurability. Each time the policy is renewed, the premium increases because of the insured increasing age. Because of the least healthy tend to renew and the most healthy tend to discontinue, the renewable feature increases the cost of protection. The renewable feature, however, is available in term life insurance. Convertibility. A term life policy with a convertibility option provides the right to convert the term policy to a whole life or another type of insurance before a specified time without proving insurability. If, for example, at age 28 you buy a term policy renewable to age 65 and convertible for 20 years, you may renew each year for several years and then perhaps at age 36 decide you prefer cash value life insurance. Your motivation may be that the premium, though higher than that of the term policy at the age of conversion, will remain the same year after year. The policy can be kept in force indefinitely, or you may want to include cash values among your investments. If you become uninsurable or insurable only at higher than standard, called substandard rates, you will find the convertibility feature very valuable. Most life insurance conversions are made at attained age premium rates, meaning that the premium for the new policy is based on the age at the time of the conversion. The insured or policy owner pays the same rate as anyone else who can qualify for standard rates based on good health and other insurability factors. The option results in no questions about your insurability. Death benefit pattern. The death benefit in a term policy remains level, decreases or increases over time. Each pattern of protection fits specific needs. For example, a decreasing term policy may be used as collateral for a loan on which the principal is being reduced by periodic payments. An increasing amount of protection helps maintain purchasing power during inflation. The increasing benefit is likely to be sold as a rider to a level benefit policy. Mortgage protection insurance is decreasing term insurance with each mortgage payment, and the face value of the insurance decreases to correspond to the amount of the loan that is outstanding. Otherwise, mortgage protection is like other decreasing term policies. Credit life insurance is similar to mortgage protection. In credit life insurance, the death benefit changes up or down as the balance changes on an installment, loan, or other type of consumer loan. Premium patterns. An insurer's rates for non-smokers may be 40% or so lower than those for smokers. Rates for women are less than for men. The yearly renewable term contract usually has a table of premiums that increase each year as the insured ages and as time elapses since insurability was established. Re-entry term allows the insured to demonstrate insurability periodically, perhaps every 5 years, and qualify for a new, lower, select category of rates that are not initially loaded for adverse selection. If the insured cannot qualify for the new rates, usually because of worsening health, he or she can either pay the higher rates of the initial premium table or drop the policy and try to find better rates with another insurer. Summary. Features of term life. In summary, in term life we see the following features: death benefits, level or decreasing; cash value, none; premiums, increase at each renewal; policy loans, not allowed; partial withdrawals, not allowed; and surrender charges, none. Whole life insurance. Whole life insurance, as its name suggests, provides for payment of the face value upon death regardless of when the death may occur. As long as the premiums are paid, the policy stays in force. Thus, whole life insurance is also referred to as permanent insurance. This ability to maintain the policy throughout one's life instead of a specified term is the key characteristic of whole life insurance. There are 3 traditional types of whole life insurance: 1. Ordinary or straight life; 2. Limited payment life; and 3. Single premium life. The differences among them is in the arrangements for premium payment. Straight life. The premiums for a straight life policy are paid in equal periodic amounts over the life of the insured. The rate is based on the assumption that the insured will live to an advanced age, such as age 90 or 100. In effect, the insured is buying the policy on an installment basis, and the installments are spread over the balance of a lifetime, as explained earlier in our discussion of the level premium concept. This provides the lowest possible level outlay for permanent protection. As shown in Figure 19.3, the level premium policy consists of a protection element and a cash value element. The cash value builds over time, and eventually, when the insured is 90 or 100, the cash value will equal the face value of the money. If the insured is still alive at this advanced age, the insurer will pay the death benefit as if the death occurred. By this time, no real insurance element exists. The options available with regard to this value are discussed later in this chapter. A basic straight life policy typically has a face amount, death benefit, that remains level over time. The pattern can change, however, by using dividends to buy additional amounts of insurance or by purchasing a cost of living adjustment rider. Limited payment life. Like straight life, limited payment life offers lifetime protection but limits premium payments to a specified period of years or to a specified age. After premiums have been paid during the specified period, the policy remains in force for the balance of the insurer's life without further premium payment. The policy is paid up. A 20-pay life insurance policy becomes paid up after premiums have been paid for 20 years. A life paid up at 65 becomes paid at the age 65, and so on. The shorter premium payment period appeals to some buyers. For example, a life paid up at 65 policy ends premiums around the time many people expect to begin living on retirement pay. If the insured dies before the end of the premium paying period, premium payments stop and the face amount is paid. These policies are mainly sold as business insurance, where there is a need to pay fully for a policy by a certain date, such as the time an employee will retire. Single premium life. Whole life insurance may be bought for a single premium, the ultimate in limited payment. Mathematically, the single premium life is the present value of future benefits with discounts both for investment earnings and mortality. Cash and loan values are high compared with policies bought on the installment plan. See Figure 19.4. Single premium life insurance is bought almost exclusively for its investment features. Protection is viewed as a secondary benefit of the transaction. Investment aspects. The typical buyer of life insurance, however, does not expect to pay income taxes on proceeds from his or her policy. Instead, the expectation is for the policy to mature eventually as a death claim. At that point, all proceeds, protection plus cash value of life insurance death claims are exempt from income taxes under Section 101A1. In practice, most policies terminate by being lapsed or surrendered prior to death as needs for life insurance change. Life insurers offer participation in portfolios of moderate yield investments, such as high-grade industrial bonds, mortgages, real estate, and common stock, in which cash values are invested with potentially no income tax on the realized investment returns. Part of each premium for all types of cash value life insurance is used to make payments on the protection element of the contract, but the protection element also has an expected return. This return is equal to the probability of death multiplied by the amount of protection. Thus, the need to pay for protection in order to gain access to the cash value element of a single premium or other investment-oriented plan should not be viewed as a consumer disadvantage if there is a need for additional life insurance protection. The participation dividend feature of a policy has a major effect on its cost and worth. Participation feature. Mutual life insurers have always sold their term and cash value life products on a participation basis. Stock life companies have also made limited use of participating policies. Participating whole life contracts pay dividends for the purpose of refunding higher than necessary premiums and sharing company profits with policy owners. Thus, an investment returns escalate above previous expectations or as mortality rates decline and policy owners share in the success of the insurer. Dividends allow the sharing of current profits from investments, mortality assumptions, and expense estimates, and lapse experience with the policyholder. Investment returns usually have more influence on the size of dividends than do the other factors. The fact that insurer investment portfolios tend to have many medium and long-term bonds and mortgages that do not turn over quickly creates a substantial lag. However, between the insurer's realization of higher yields on new investments and the effect of those higher yields on average portfolio returns that affect dividends. Participating whole life insurance continues to be a major product line for mutual insurers. Sales illustrations are used by agents in presenting the product to the consumer. For products with the participation feature, Dividends projected for long periods into the future are a significant part of the sales illustration. Generally, the illustrations are based on the current experience of the insurer with respect to its investment returns, mortality experience, expenses, and lapse rates. The reading continues, and there's a bit more reading in Objective 3. However, this concludes our brief read-through of Unit 7, Life Insurance and Entitlements.